Today's Wall Street Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from Journal: Verizon logs big subscriber gains under new CEO. Verizon just added 616,000 post-paid phone customers in a single quarter, and the CEO is calling it a critical inflection point. That's not a phrase you use casually in a business this mature. When a company of Verizon's size throws that line down on an earnings call, it's telling you the old trajectory was unacceptable, and this is the moment we are trying to bend the curve. This whole story comes from the Wall Street Journal, and if you read it like an investor, not like a news consumer, it's about far more than one strong quarter. It's a case study in what happens when a dominant incumbent coasts on its position, gets punched in the face by competition, and then has to relearn what operating discipline actually looks like. Let's start with the character at the center of this, Dan Schulman. He's stepping into Verizon as CEO with a very specific mandate: execute cost cuts and drive a strategic turnaround after the company lost ground to rivals. This isn't a keep the ship steady appointment. This is a fix what's broken appointment. Before taking over, Schulman ran PayPal. He also served as Verizon's lead independent director. That's important. As board lead, he's already spent time inside the system, watching the old leadership's decisions, seeing the incentives, seeing where the frictions are. When a board member steps into the CEO role, the board is effectively saying, "We tried to nudge from above, now we're going to hand you the keys." So what's his role? As a builder, his job is to rebuild Verizon's growth engine. Specifically, to reignite subscriber growth in a market where the easy growth years are gone. As an allocator, his job is to decide where each dollar of capital and each dollar of operating expense actually earns a return: network, promotions, acquisitions like Frontier, or cost cuts returning to shareholders. As a constraint, he has to decide what Verizon will stop doing, which spending patterns, pricing habits, and cultural defaults no longer belong in a world where even the largest carrier can lose customers. To understand what's changing, you have to see what worked for a long time. For years, Verizon played the classic incumbent game: build a high-quality network, charge a premium, and rely on the friction of switching to hold customers in place. The network was the moat, the brand was the comfort, and small price increases were tolerated. That model works until two things happen. First, competitors like T-Mobile get aggressive on both network and price. Second, your own internal habits drift toward complacency. You start thinking of price as the primary lever, not value. The Journal makes one line brutally clear: Verizon had been raising prices without increasing the value it offered. That prior approach, in Schulman's own words, was driving customers away. Think about that as an owner. Raising prices is tempting. It's fast. It flatters the income statement. But if you're not increasing perceived value at the same time, you are quietly destroying the asset you actually own, the customer relationship, and the future cash flows it represents. And you see the result in the pattern that led up to this so-called inflection point. After a good holiday quarter a year ago, Verizon then shed core consumer post-paid phone connections in each of the subsequent 3 quarters. This is the core product. Post-paid phone customers are the heart of the franchise. Losing them quarter after quarter is a very loud signal that the old playbook stopped working. So what's different now? In this most recent quarter, Verizon added a net 616,000 post-paid phone connections. That's not just a good result, it's far better than what they themselves expected. The company had guided to about 417,000 net additions. They overshot their own forecast by nearly 200,000. And it's not just phones. This quarter represented the biggest combined mobile and broadband net additions since 2019. Here are the key facts. Fourth quarter revenue: $36.4 billion, up 2% year over year, slightly beating analyst expectations. Wireless service revenue: $21 billion, still the core business. Earnings per share: 55 cents, or $1.09 excluding special items. Profit was reduced by severance charges from layoffs. Total wireless retail connections at the end of the period: 146.9 million. So, one level down, what decisions are generating these results? The first is painful but straightforward. Schulman ordered Verizon's largest ever round of job cuts in November. That's a direct attack on the cost base. The company now expects to realize $5 billion in operating expenditure savings this year. The second is strategic. He's saying publicly that Verizon is examining every dollar of operating and capital expenditures, continuing to streamline operations, and focusing on fiscally responsible growth. The third is behavioral. He's drawing a line on pricing. Verizon, going forward, will not raise prices without increasing the value it offers. That's more than a marketing line. That's an admission that the old incentive, maximize ARPU in the short term, created churn and undermined long-term compounding. Now, I want you to picture the visual that accompanies this story, because it's the purest expression of an inflection point. On the screen, you're seeing Verizon's own chart of quarterly net postpaid phone connections. The horizontal axis runs through 22,000 and 22,005, quarter by quarter. The vertical axis is labeled in 100,000 increments, from negative 400,000 at the bottom to negative 200,000 to 0 up to positive 600,000 at the top. Most of the bars are short and choppy. Some dip below the zero line into negative territory. Those are the quarters when Verizon lost more postpaid customers than it gained. You can almost feel the drift, the erosion. Then, on the far right, there's one tall bar stretching close to the top of the chart, labeled 4Q 22,000 plus 616, 000. That's the quarter we're talking about. What is being measured is simple, the net change in the number of postpaid phone connections each quarter. But what it actually tells you is how the strategy is working in real time. In telecom, strategy shows up as subscriber net adds. That bar is the scoreboard for decision-making. Most people just see that last bar and think, nice rebound. As investors, we should see the entire shape of the chart as a story about incentives. When management chased price increases without increased value, you see red or weak quarters. When they pulled back, got aggressive on customer acquisition, and started fixing the cost structure, you see a spike in net adds. Even in a period that the article describes as competitive, with both Verizon and T-Mobile launching promotions to lure each other's customers. That single image is the CEO's argument made visible. We were on the wrong path. We're trying to turn. Now, look at how capital is being deployed alongside those operating moves. In this same period, Verizon added 372,000 net broadband connections. And just after the quarter, in January, it closed a $9.6 billion acquisition of Frontier Communications. That deal brought total fixed wireless and fiber broadband connections up to 16.3 million. This is not random. It's a strategic bet. Sell customers both mobile service and home internet, and do it in a way that ties them more deeply into the ecosystem. On top of that, Verizon added 319,000 net fixed wireless connections in the quarter. Fixed wireless uses cell towers instead of cables to reach the home. That means it's leveraging the existing wireless network to compete in home internet. So what's the decision autopsy here? First, the old pricing decision. What was expected? Raise prices on a large, sticky customer base, boost revenue and profit per user, and carry on. What happened? Higher prices without clear added value pushed core postpaid customers away, creating 3 straight quarters of net losses. In the most important segment, opportunity cost, the lifetime value of those lost customers. 10 or 15 years of cash flows from a single high-value line can be worth multiples of a short-term ARPU bump. Multiply that across hundreds of thousands of lost lines, and the foregone compounding is enormous. Second, the layoffs and cost cuts. What is expected? By cutting jobs now and re-examining every dollar, the company can take out $5 billion of operating expenses this year. That, over time, should lift margins and free up cash for either reinvestment or returns to shareholders. What actually happens will take time to see. In the short term, severance charges hit earnings. The culture gets shocked. The risk is you cut muscle along with fat. The opportunity is you reset the internal incentive structure so that spending has to justify itself. The hidden trade-off: internal morale, execution risk, and the ability to innovate. Cost cuts can either sharpen a company or hollow it out. The numbers in the article, earnings pressured by severance but subscriber trends improving, suggest Schulman is willing to take pain in the income statement to fix the top line and the cost base at the same time. Third, the Frontier acquisition and broadband push. What is expected? By spending $9.6 billion to acquire Frontier's assets, Verizon expands its fiber footprint and accelerates its strategy of being the provider of both mobile and home internet. More connections, more bundling, more share of wallet, lower churn. The reality so far: 372,000 net broadband additions in the quarter, 319,000 net fixed wireless additions, and total fixed wireless and fiber broadband connections at 16.3 million. Opportunity cost: $9.6 billion could have gone into share repurchases, debt reduction, or other investments. Management is betting that owning and expanding the connectivity into the home, especially through fixed wireless that rides on existing towers, creates a more durable compounding engine than simply doubling down on the phone side. Finally, the CapEx and revenue guidance. Verizon is forecasting capital expenditures of $16 to $16.5 billion for 2026, down from $17 billion in 2025. At the same time, they project wireless service revenue to be fairly flat, while total mobility and broadband service revenue grows by 2% to 3%. That tells you how Schulman sees the world. The era of building and spending for breakneck growth is over. This is about sweating the existing asset base more intelligently, tightening capital discipline, and squeezing more cash flow out of each invested dollar. There's a clear pattern across all of these decisions. Success carried too far became failure. Success as the dominant wireless carrier made it easy to believe that you could push prices faster than value, that you could coast on your network quality and brand, that you didn't need to be scrappy. The article is, at its core, about the consequences of that belief. The lost customers, the forced job cuts, the need to adopt promotions in a competitive quarter just to regain momentum. Now, let's do the reality check. Top line: 2% revenue growth to $36.4 billion. Wireless service revenue of $21 billion. Earnings per share of 55 cents, or $1.09 excluding special items. Subscriber line: 616,000 net postpaid phone additions, blowing past 417,000 that the company expected. 372,000 net broadband additions. 319,000 net fixed wireless additions. Forward view: a forecast to add 750,000 to 1 million net postpaid phone connections this year, with overall mobility and broadband revenue growing 2% to 3%. Here's what those numbers say that the narrative doesn't. First, subscriber growth is outpacing revenue growth. That's usually a signal that either pricing is under pressure or the mix includes more promotional, lower ARPU customers. Remember, this was a quarter where both Verizon and T-Mobile launched promotions to lure rivals' customers. Second, the big story in the press is Verizon gains back subscribers under a new CEO. The quieter story in the numbers is the company is going to be grinding. Wireless service revenue is expected to be fairly flat this year, even as they add hundreds of thousands of net postpaid lines. The 2% to 3% growth is coming from the broader mobility and broadband basket, including home internet. Third, this is not yet a clean, high-margin compounding story. It's a repair job. It includes severance charges, cultural disruption, integration of a $9.6 billion acquisition, and a new pricing philosophy. That doesn't mean it's unattractive. It means you have to judge the operator, Schulman, on his ability to balance all those moving parts without breaking the machine. So what are the lessons here for long-term owners? Lesson 1. Incentives compound faster than capital. Verizon's old incentive system rewarded revenue and ARPU growth in the short term. That pushed the company into raising prices without increasing value, which in turn drove customers away. When the incentive changes, when the CEO says, "We will not raise prices unless we increase value," you start to see different behavior. Cost cuts, sharper promotions, a focus on bundling rather than gouging. Over a decade, those incentive shifts will matter more than any one quarter's subscriber number. Lesson 2. Scale becomes a disadvantage when it breeds complacency. Verizon's sheer size, 146.9 million wireless retail connections, made it easy to believe they were untouchable. That scale delayed the recognition that T-Mobile and others were chipping away at the edges. By the time the company admitted the problem, it had 3 straight quarters of core subscriber losses to dig out of. Scale is only an asset if the operator treats it like something fragile that has to be earned every day. The moment you start to think, We're the biggest, we can push prices, they'll stay. Your scale turns into a slow-motion liability. Lesson 3. Most failures come from success carried too far. The moves that built Verizon, network investment, pricing power, brand strength, were exactly the moves that, extended too long without adjustment, started to hurt it. The same mindset that says, we can raise prices because customers trust our quality, becomes the mindset that ignores the pain customers actually feel when their bill goes up, with nothing new added. The turnaround we're seeing now, job cuts, cost discipline, a broadband push built on both fiber and fixed wireless, is an attempt to evolve the system beyond the behavior that made it successful in the first place. At the end of the day, the core question from this Wall Street Journal article is simple. Is this really an inflection point for Verizon, or just a good quarter dressed up as a turning point? Based solely on what we're given, the numbers, the language, the commitments, it looks like the company has at least recognized the real problem. Not a lack of network, but a lack of discipline in how it priced, spent, and treated the customer. Recognition is the first step. Execution is the rest of the journey. If you think like an owner, you watch what Schulman does next, how aggressively those $5 billion of cost savings show up in free cash flow, whether subscriber gains persist once promotions normalize, and whether capital expenditures, now guided lower, still support a network that justifies the brand. Because for a business like this, one sentence should be burned into your mind. The true inflection point is not when the numbers finally move, it's when the incentives behind those moving to next title. Gold, silver suffer worst day since 1980. Silver fell 31% in a single day. That's the kind of number you associate with a small cap fraud or a meme stock that just got rug pulled, not with one of the oldest monetary assets humanity has ever trusted. And yet that's exactly what happened, as reported in the Wall Street Journal. Gold futures had their biggest one-day dollar decline on record. Silver had its worst day since the era when the Hunt brothers tried to corner the market and blew themselves up. In one session, the safe haven trade looked more volatile than the casino it was supposed to hedge against. This moment matters because it reveals, in a very loud way, what's usually hidden. How much of today's so-called hedging is actually speculation wrapped in a story about safety? It shows you how fragile a trade becomes when it's built more on narrative than on underlying cash flows. And it's part of a bigger and very old pattern: fear of currency debasement, a rush into hard assets, a speculative overshoot, and then a violent repricing when policy or perception shifts. Let's unpack the operators, the incentives, and the decisions that got us here. The central figures in this story are not founders in the usual sense. They're system architects. You have President Trump, who wants a particular kind of Federal Reserve, one that he believes will help him get the growth and market behavior he prefers. You have Kevin Warsh, a former Fed governor whose transcript in this piece is clear. He's historically been more worried about inflation running too hot than about growth running too slow. Markets read him as a hawk on inflation and on the dollar. You have the existing Fed under Jerome Powell, which markets had started to assume would eventually succumb to political pressure and keep rates too low for too long. And then you have a whole ecosystem of traders and allocators who built what Wall Street started calling the debasement trade, betting that investors all over the world would lose faith in traditional currencies like the dollar and would crowd into gold and silver as a kind of escape hatch. Those are the decision makers. Those are the builders and allocators whose moves created the conditions for that 31% intraday collapse. For months, gold and silver had been on what the journal calls a gravity-defying rally. Prices pushed to all-time highs. The story underneath was simple and powerful. Governments are printing, inflation is here, fiat is dying. You need metals. That's the narrative that enticed speculators, not just hedgers. What worked during that phase was the feedback loop. Prices rise. Headlines scream about record highs. More people buy because they're afraid of missing the protection or missing the gains. Higher prices seem to confirm the thesis that currencies are being debased. That confirmation pulls in yet another wave of money. But what quietly stopped working, long before this one violent day, was the connection between price and underlying use value. At extreme levels, gold and silver weren't just hedges. They were becoming problems for real businesses. The article points to solar panel makers, auto parts manufacturers, industrial users whose input costs were getting jacked up by this speculative rally. That's your signal that the trade has moved away from fundamental hedging. towards something else. The inflection point came not from within the metals market but from the hiring market. Specifically, one job, Fed chair. The selling began around the time reports surfaced that President Trump would nominate Kevin Warsh to succeed Powell. For Wall Street, the message was blunt. A Warsh Fed is less likely to buckle to pressure for lower rates. It's more likely to prioritize keeping inflation in check and defending the dollar. In other words, the perceived future path of money itself changed. If you were long gold and silver because you believed the Fed would stay behind the inflation curve and debase the dollar, the Warsh news attacked the core of your thesis. If the dollar is going to be defended more aggressively, if inflation is going to be treated as the main enemy, then the payoff from the debasement trade shrinks fast. After Trump confirmed the pick, the dollar had its strongest day in months. Stronger dollar, weaker metals. That's the clean translation. Now let's talk about the actual moves, because as value investors, we should always force ourselves to stare at the numbers, not just the narrative. Silver futures for February had ended the prior session at more than $114 a troy ounce. By the end of this sell-off, they settled at $78.29. That's a drop of $35.747 per ounce. The article notes that $35+ was roughly the entire price of an ounce as recently as June. Think about that. In one day, silver lost more than the entire price of an ounce just a few months earlier. That's how stretched the prior move had become. 31% down in a single session, worst percentage drop since the Hunt Brothers saga decades ago. Gold didn't get off lightly either. Front-month gold futures plunged 11%, landing at $4,713.90 a troy ounce. That's the steepest one-day decline in more than 40 years. Even if you don't trade commodities, those magnitudes should stop you. These aren't penny stocks. These are the supposed anchors in a storm. On the equity side, the shock spilled over. Mining stocks were hammered, dragging the S&P 500 down by 0.4%. The Dow fell 0.4%, which translated into a 179-point decline. The Nasdaq Composite dropped 0.9%. So, in a sense, the volatility in the hedge asset contaminated the broader equity indices. The thing that was supposed to give safety ended up being a source of risk. That's a pattern worth remembering. Now, some analysts framed this as a much-needed reset. After a dizzying rally that pushed prices to highs and squeezed industrial users, a brutal pullback brought a bit of sanity back. Importantly, even after this beating, both gold and silver still finished January significantly higher. The debasement trade on a month-long chart is still up, and that tells you something subtle but important about compounding. The real danger is not one bad day. The real danger is stacking days and months where the underlying thesis is decaying but price is still rising. That's when people over-leverage. That's when companies change their capital allocation to chase a trend. By the time the reset comes, it simply compresses a year's worth of mispricing into one new cycle. Who was actually selling into this collapse? Here's where the article is honest, and where we should be too. On Friday, analysts floated a few mechanical drivers. End-of-month profit-taking from fast money traders. Banks hedging themselves against the impact of a sudden drop in the metals. Those behaviors can add fuel to a move that already has a clear narrative trigger. Adrian Ash, who runs research at a precious metals marketplace called Bullion Vault, summed up the strangeness of it. He says, "I've been in the market for 20 years. I've never seen anything quite like this market." That's someone who's lived through multiple cycles telling you this particular combination of levels and volatility is unusual. But Ash also does something very useful for us as investors. He knocks down an easy, lazy explanation. It's tempting, when you see gold and silver swing like this, to blame retail mania, small investors in China or elsewhere piling in and then suddenly bailing out. That fits nicely with the meme stock analogy the article uses. Precious metals swinging like meme stocks. Ash throws cold water on that. He points out that base metals like copper also made strange moves. Copper futures fell 4.5% on that same Friday. Copper is not a retail favorite. There is essentially no retail participation in base metals. Copper exists in the portfolios of industrials, hedgers, and institutions. So when copper falls sharply alongside gold and silver, it tells you this is not just a bunch of day traders panicking at home. This is a system-wide de-risking across metals, driven by big money, hedging desks, and algorithmic strategies tied to macro triggers. That's your reality check. The same infrastructure that made it easy for everyone to pile into the debasement trade on the way up also makes it easy for that trade to unwind violently when the story shifts. Let's talk about the chart on the screen, because it compresses 6 months of behavior into one image. What you're seeing is a simple line chart covering the past 6 months of futures and index performance. 3 lines, one for silver, one for gold, one for the S&P 500. The horizontal axis runs from late summer to the current month. The vertical axis measures percentage change over that period. The S&P 500 line is the baseline. It oscillates, sometimes up, sometimes down, but within a relatively modest band. Equity volatility, but not insanity. Then you see the gold and silver lines. They start around the S&P, then begin to diverge. Over months, they climb higher and higher, well above the stock index. That's the debasement trade playing out visually. Precious metals outperforming equities decisively as fear about currencies builds. As you approach the right side of the chart, the most recent days the precious metal lines spike, then shear downward in a cliff-like drop. That last vertical move is the day the Warsh nomination gets reported and then confirmed, the day the dollar rips higher and metals collapse. What's being measured is just prices. But what it's really showing you is crowd psychology attached to policy expectations. The creator of that chart is essentially saying, look how far this got away from the baseline and how fast it snapped back when the belief system changed. Most people see that chart and say, wow, volatile. As a long-term investor, you should see something else, the danger of anchoring your portfolio to macro narratives you cannot control, and that can flip in a single headline. Underneath all of this is one very simple incentive function: policy and the dollar. Investors who were worried about the future of the dollar in an era of higher inflation, in the journal's words, piled into gold and silver. That's the debasement trade in a sentence. They were betting that the people running the system, politicians and central bankers, would not have the will or the ability to protect the currency's value. The moment the market started to believe that a future Fed chair would, in fact, be tougher on inflation and friendlier to a strong dollar, that bet had to be repriced. Trump confirming Warsh's pick was the catalyst. The dollar posted its strongest day in months. Metals repriced lower. Mining stocks took a hit. The S&P sagged a bit in sympathy. And yet, from a business quality and capital allocation perspective, the real story isn't the candle on that day. It's what companies and investors did during the run-up. Mining companies that treated the prior price spike as permanent may have committed to projects, cost structures, and leverage levels that only make sense at bubble prices. That's success carried too far. High prices encouraging marginal capital expenditure that a more sober assessment would have rejected. Industrial users, the solar panel producers, the auto parts manufacturers, were on the other side of that. High metals prices jacked up their costs. For them, this violent pullback is actually a release valve. Their own capital allocation decisions, whether to build, whether to invest, whether to expand, depend critically on input costs. A speculative overshoot in metals can freeze good projects. A reset can unfreeze them. So when some analysts in the article call this a much-needed pullback, what they're really saying is prices have to work for the real economy, not just for the macro trade. Now, what can we actually take away from all this as investors who care about compounding over decades, not days? First, incentives shape outcomes more than stories do. The debasement trade story was compelling. It pulled in capital, headlines, podcasts, and social chatter. But the real driver was the incentive structure. Politicians wanting easier money, markets believing they'd get it, and traders leveraging that belief. The moment the incentive picture changed, when a more hawkish Fed candidate appeared, the market had to reprice the whole story. If your portfolio is built on stories, without understanding the incentives underneath them, you are always one appointment, one nomination, one regime shift away from a 31% day. Second, scale becomes a disadvantage when it's attached to leverage and liquidity, not to cash flows. Gold and silver are massive markets. But when a big chunk of that market is held by fast money, levered traders, complex derivatives, banks hedging exposures, scale doesn't give you stability. Scale makes the unwind bigger and more violent. Think about it this way. The bigger the pool of capital that piled into the same trade for the same macro reason, the more air that has to come out when the thesis changes. Size without discipline becomes a risk amplifier. Third, success plants the seeds of failure when it disconnects from real-world users. The success of the precious metals rally, those all-time highs, created conditions that hurt industrial users. When the cost for a key input suddenly doubles or triples because of speculative flows, the companies that actually use that metal to build things are being taxed by traders. That invites a counter-reaction. Demand adjusts, substitutions get explored, projects get delayed. Eventually, reality reasserts itself. Prices that are too far above what the real economy can sustain simply don't last. The same success that excited speculators sets up the snapback that punishes them. So, what's the core question this Wall Street Journal piece is really asking? Underneath the headlines, it's not, should you own gold? Or will silver go back up? The deeper question is, do you want your long-term compounding to depend on the mood of a crowd reacting to central bank personnel decisions? Or do you want it to depend on businesses that create value regardless of who sits in the chair? Both can make money, but only one gives you a foundation you can sleep on. If you remember nothing else from this day when gold and silver traded like meme stocks, remember this: any asset that people buy to escape risk becomes the riskiest place in the market the moment everyone tries to escape through the same door. Moving to next title, memory shortage haunts Apple's blowout iPhone sales. iPhone revenue surged 23% to more than $85 billion in one quarter. That's not some small cap having a good year. That is Apple's largest business segment putting up its best December quarter growth in more than a decade. That fact alone, from this piece in the Wall Street Journal, tells you two things at once. The iPhone 17 lineup is working, and the iPhone is officially in a new phase of its life. This moment matters because it sits right at the intersection of three compounding forces: a mature flagship product that still drives the bus, a supply chain that is being distorted by the artificial intelligence boom, and a capital-intensive memory market that can quietly decide whether Apple hits or misses its margin targets. Underneath the headlines, this isn't just about Apple crushing it. It's about what happens when the world's most valuable consumer hardware franchise collides with scarcity, in chips, in memory, and in replacement cycles. The central figure here is Tim Cook. He's not the founding visionary. He's the operator who inherited the machine and then refined it into an execution engine. This article shows him in that role, on the earnings call, explaining that Apple has depleted much of its inventory and is now in supply chase mode. That's a supply chain guy talking, which is exactly what Cook is at his core. Look at his role through three lenses. As a builder, he's overseen the evolution of the iPhone into a product that can still generate more than $85 billion of revenue in a single quarter, even when the category is mature and consumers are keeping phones longer. The current iPhone 17 family is proving to be a hit strong enough to produce that 23% year-over-year revenue surge. As an allocator, he has to decide how to navigate scarcity. There is a finite amount of leading-edge chip capacity in the world, and that capacity is being bid up by artificial intelligence workloads from Nvidia and AMD. There is a finite supply of flash and DRAM memory, with demand booming from AI systems. Every decision about how Apple spends on components, how much inventory it carries, how it prices each model, is ultimately about capital allocation under constraint. And as a constraint himself, Cook defines what Apple will not do. Does he compromise on memory specs to protect margins? Does he raise prices and risk stretching replacement cycles even further? Does he accept lower margins for a while to keep the ecosystem growing? None of those trade-offs are written in the article, but the pressures are. Let's walk through exactly what's happening. For months, people have been saying, "I'll wait for the AI iPhone." The article opens by telling you that's not what's happening. iPhone buyers are not waiting around for better artificial intelligence features. They're buying now. For Apple, the journal calls that both good and bad news. Good because the numbers are incredible. iPhone revenue up 23% year over year to more than $85 billion. Best December quarter growth for that segment in over 10 years. Total company revenue projected to grow 13 to 16% for the March quarter, versus the 10% analysts were expecting. That guidance beat alone tells you Apple sees momentum continuing, at least for the next few months. But the very strength of this cycle is also creating new problems. During the call, Cook explains that Apple depleted much of its iPhone inventory during the quarter. They sold so much that they're now chasing supply. For a company famous for its supply chain mastery, that's a big statement. They're in supply chase mode to get more phones produced. And it's not just about final assembly. The company admits it is having trouble securing enough production capacity for the most advanced processing chips that power its latest products. Here's where the story widens. Those cutting-edge chips are made by TSMC in Taiwan. Apple is TSMC's main customer for smartphone processors. But TSMC is also the primary producer of AI chips for Nvidia and advanced micro devices. Those AI chips are red hot and command very high prices. The article points out that smartphone chips, as a share of TSMC's revenue, fell from 38% in 2030 to 29% last year. Same factory, same limited number of production lines, but the mix has shifted toward AI. The more those lines are devoted to AI accelerators, the less spare room there is for smartphone processors, including Apple's. So think about the incentive structure for TSMC. On one side, you have Apple, massive, stable, top-tier customer, demanding huge volumes of advanced phone chips at negotiated prices. On the other side, you have AI customers paying up, in a frenzy for capacity, because those chips sit at the center of a once-in-a-generation compute build-out. TSMC's job, as an allocator, is to maximize long-term value across that portfolio. Short-term, the math pushes them toward AI. Higher margins, higher prices, long backlogs. That inevitably squeezes capacity for smartphones, which means even Apple can find itself in a queue. And down in Cupertino, Tim Cook is now running one of the most profitable hardware businesses in history, on top of someone else's constrained production lines. That is a very different world than the one Apple dominated a decade ago. Now let's layer on memory. The article makes it very clear. Sharply rising costs for memory chips are another major concern for Apple because memory is also in a severe supply shortage thanks to AI. Flash memory and DRAM are important components in any computing device. That includes phones, PCs, and AI servers. Industry analysts quoted here are projecting that some smartphone and PC makers will be forced either to downgrade memory specifications in their products or to raise prices in order to manage demand and protect profit margins. This is where capital allocation and product design collide. If you lower memory specs, you protect your bill of materials, but risk making your devices feel slower or cheaper, especially as apps and operating systems become more demanding. That can hurt the brand and compress long-term pricing power. If you raise prices, you might preserve gross margin percentage, but you also lengthen replacement cycles and shrink the addressable market at the high end. The article already notes that rising prices have compelled users to hang on to their phones longer, stretching out the time between the super cycles investors love to see. Apple, in the article's words, gave little hint of its own plan to handle this memory crunch. That silence is telling. The choices are all hard. To see how tight the squeeze is, the journal brings in another actor, SanDisk, the flash memory maker. SanDisk reported a 61% jump in revenue for the December quarter and projected a near tripling in the March ending period. That's extraordinary growth. It reflects demand not just from consumer devices, but from the whole AI and cloud infrastructure wave. At the same time, SanDisk projected its own gross profit margins picking up slightly to 48.5% in the current quarter. Not collapsing, not exploding, just picking up slightly. That tells you memory suppliers believe they can both grow revenue aggressively and hold, even improve margins in the near term. If you're Apple, that translates into real component inflation. The people you buy memory from are suddenly enjoying 60+% revenue growth and better margins. They are not discounting aggressively to win your volume. Their dance card is full. Now, the other side of the Apple investment case has always been margins. The article reminds us that Apple's profit margins are closely watched by investors and remain a crucial part of the company's appeal, especially as overall growth has slowed in recent years. Investors, using visible alpha estimates, expect Apple's gross margins to rise steadily over the next 3 years. That expectation is part of the multiple the market is willing to pay. On the screen right now, you'd see the journal's chart of Apple's annual gross profit margins. The horizontal axis runs from fiscal 2015 through 2025. The vertical axis is labeled from 0 to 60%. The line for Apple's margins moves through those years, then continues as a projected line into the future, gently sloping upward according to analyst estimates. The label makes it explicit: Apple's annual gross profit margins, with projections on the right-hand side. What is being measured there is simple: gross profit as a percentage of revenue each year. What it's really telling you is the story investors are telling themselves about Apple's ability to pass cost pressure on to customers, or offset it with mix and efficiency. Most people glance at a chart like that and see comfort. Margins have been high, they'll probably stay high. What the creator of that chart is really saying is, this entire equity story assumes Apple can keep expanding gross margin despite a maturing flagship and rising component costs. That is not a law of nature. That is a bet on operational excellence and pricing power. Now overlay one more reality from the article. The iPhone business is mature. The journal points out that over the past 3 years, iPhone sales have averaged only 1% growth per quarter. That's very low single-digit growth. You don't get 30% growth in a mature segment unless something unusual is going on. What's going on right now is the iPhone 17 cycle. The current lineup is a hit. That's generating the 23% revenue jump. But the article is careful. That strength also raises the possibility that the next lineup won't sell as well, even if Apple brings in the significant AI enhancements users have been waiting for. This is a key pattern for us as investors. Supercycles borrow demand from the future. When a new iPhone family does extremely well, especially in a replacement-driven market, you're effectively pulling forward buyers who might otherwise have upgraded later. That can flatten or even depress the next cycle. The article hints at exactly that. Today's blowout reduces the odds of tomorrow's blowout, even if tomorrow's phone is better on paper. On the screen now, picture the image the journal includes. A photograph of Apple's iPhone 17 series. Sleek devices laid out in a row, gleaming displays, clean industrial design, the kind of lifestyle marketing shot you see in launch events and product pages. Underneath, the caption tells you what you already know from the numbers. This series is proving to be a hit. Most viewers, seeing that image, just register desirability. From an owner's angle, you should see inventory and margin risk. Every one of those shiny rectangles is a small working capital decision. How many units to build, which configurations to emphasize, how much memory to include at each price point, and how long you expect that particular model to carry its share of the gross profit burden. The article also notes something important about timing. Investors and consumers aren't going to get a clear picture of Apple's AI enhancements for a while. Apple traditionally saves those major software announcements for its June Developers Conference. Between now and then, the company will be busy dealing with the supply crunch in memory and other key inputs. So the market is living in a period of asymmetry. Strong hardware numbers now, incomplete information about the next wave of software-driven value. That is exactly the kind of window where speculation creeps in, where narratives about AI iPhones can get bigger than the actual near-term business reality. Let's pull this together into 3 lessons for long-term owners. First, incentives shape outcomes more than narratives do. The narrative right now is, Apple is crushing it on iPhone 17. AI is coming, margins will rise. The incentive landscape is more complicated. TSMC is incentivized to favor AI chips because they are more profitable and in scarce supply. Memory makers are incentivized to keep prices firm as demand surges from AI and cloud customers. Consumers are incentivized to hold onto their phones longer as prices rise. When you map those incentives, you see a triangle of pressure on Apple: supply constraints for processors, higher costs for memory, and elongating replacement cycles. Any margin expansion from here is being earned against that headwind. Second, scale becomes a disadvantage when you are fighting for constrained inputs. Apple's scale in iPhones used to be an unambiguous strength. It could command the supply chain, lock up capacity, and negotiate better prices. In a world where AI soaks up leading-edge fabs and memory fabs, that same scale makes Apple a very large, very visible demander of scarce parts. When there is red-hot demand and high prices for AI chips, and smartphone chips have already slipped from 38% to 29% of TSMC's revenue, Apple's size doesn't guarantee priority. It guarantees that the company's problems, if mishandled, will be very big in absolute dollar terms. Third, success plants the seeds of failure when it blinds you to the maturity of your flagship. The very fact that iPhone 17 is such a hit is what creates risk for the next cycle. The iPhone, as the article says, is now a mature business. 1% average sales growth per quarter over 3 years. Rising prices, pushing users to keep devices longer. If you treat this 23% revenue jump as the new normal, Instead of as a cyclical spike in a mature category, you're setting yourself up, whether you're on the investor side or the operator side, for disappointment. The smart move is to see this as a windfall that has to be invested wisely. In services, in new categories, in the software and AI layers that increase the lifetime value per device, not just the upfront ticket price. So, what is the core question raised by this Wall Street Journal piece? It's not, is Apple still great? The article's numbers answer that. $80 to $5 billion in iPhone revenue in one quarter is greatness. The deeper question is, can a mature flagship, living in a world of constrained chips and scarce memory, continue to be the engine of margin expansion investors are counting on? Or is this blowout quarter actually a warning that the system is closer to its limits than it looks? The answer, based solely on what we see here, is that Apple is still one of the best operators on Earth, but even the best operator is now negotiating with physics, fabs, and replacement cycles, not just with competitors. And that's the line I'd leave you with. When the world's most profitable product has to fight for chips and memory, you're no longer just betting on the product. You're betting on the operator's discipline at the edge of scarcity. Now, towards last article, like my blouse? It's AI. This story comes from the Wall Street Journal, but it is not sitting on the markets page. It's in Style and Fashion. On the surface, it looks like a light piece about pretty prints and AI tools. Underneath, it's a hard look at what happens when a creative industry that has always sold the human touch starts quietly automating parts of the process. For investors, this matters because fashion is a brutal business. Margins are fragile. Trends are short. Brand is everything. When you introduce a technology that can save weeks of design time, cut sampling costs, and change who gets hired, you are tampering directly with the engine of compounding in these companies. The central figure here is Stacey Bendet, the founder-designer behind Alice plus Olivia. For 24 years, she's been her own muse. The article literally says she looks like the brand's doll-like logo. That's not just a cute line, that's founder as brand made physical. Alice plus Olivia is a $300 million business built on that aesthetic. Embellished denim, party dresses, a very specific stylized femininity. For 2 decades, what worked for Bendet was simple. Her taste, translated through a traditional creative process. Hand-painted prints, in-house designers, slow sampling. Craftsmanship. That's how you build a premium label. The founder is the builder, the allocator of taste, the constraint on what gets the brand's name. Now she's saying something very different. Everyone is scared about AI reducing creativity, she says. I look at AI as a creative explosion. That's an inflection point. She admits she fell for tech hype before. She calls the NFT craze of the early 2020s a gimmick and a joke. That's a founder with scars. She chased one wave that didn't compound. But on AI, she says, it is changing our lives. So what changed? On screen right now, you're seeing an Alice plus Olivia spring look. A long pleated skirt and a silk bomber jacket covered in an ethereal tarot card print. The surface is dreamy. Goddesses, symbols, a kind of French-inspired mysticism. The caption explains the key fact. This print was made with the help of Leonardo AI and Adobe Firefly. Here's how they did it. The team fed the AI images of a similar hand-painted print they had created back in 2017. So the input is their own archive, their own IP. The prompt, give us a new goddess French-inspired tarot theme. The AI spits out options. Ariana Moultrie, the senior print and concept designer, then steps in as editor. She uses Photoshop to fix small mistakes, like a lion's face that got blurred. She calls the results mind-blowing after a few weeks of learning the tools. That workflow is important. AI isn't replacing the designer. It's becoming a force multiplier. Instead of starting from a blank page, she's starting from dozens of AI-generated variations on a house style. Instead of weeks, she might spend days. From a capital allocation perspective, this is huge. Time is money in fashion. A collection has to be designed, sampled, shown, produced, and shipped on a tight calendar. If AI saves days, sometimes even weeks, as Bendet says, you are shortening the design-to-shelf cycle. You're reducing sampling costs. You're lowering the working capital trapped in iterative prototypes. That translates directly into higher velocity and, potentially, better return on design dollars. But you can already see the downside. If everyone has the same tools, the same prompts, the same models trained on overlapping sources. The risk is not just job loss. The risk is sameness. The article makes it clear. Alice plus Olivia is not alone. More and more fashion brands are bringing AI into the design process. It can create prints from a few prompts. It can turn hand sketches into lifelike product renderings that factories can understand. It can digest entire archives and tweak existing products. It can take vague ideas and spit them out as mood boards. The argument for AI, from the operator's point of view, is straightforward. More ideas, faster. More options, cheaper. Now flip the lens to jobs and moats. Bendit herself says AI could hurt entry-level roles, specifically tech-packed designers, the people who create the detailed manufacturing instructions for factories. Those are the classic junior jobs. You learn the nuts and bolts, you slowly move up to more creative work. If AI eats that layer, you lose the apprenticeship ladder. But she also says she'll need more designers who really know how to use AI programs. So the skill mix shifts. Fewer people doing rote translation work. More people acting as creative directors over machines, knowing what to feed in, how to judge the outputs, how to fix the uncanny mistakes. From a business quality perspective, that's a rewiring of the creative supply chain. Entry-level costs may go down. Mid-level and senior creative talent who can orchestrate AI may become more valuable. The number of humans touching each design might shrink, but each of those humans matters more. And then there's the broader macro backdrop. This article reminds us that AI was responsible for about 55,000 job losses in 2025, across industries according to a Challenger Gray and Christmas report. Musicians watching chart-topping hits made with song generators. Hollywood reacting to an AI movie star named Tilly Norwood. Fashion is not special. It's just late to the same party. The question for us as investors is, does this tech deepen or weaken the moat? For some houses, AI is just a faster Photoshop. For others, it becomes a way to lock in their archive and taste for the long run. Look at Norma Kamali. She broke out in the 70s. She has a 59-year archive. Instead of letting that archive sit in boxes and old files, she's feeding it into a custom-built AI. Her words, it's a succession plan. It can be used long after I'm gone. On screen now, imagine a mental image rather than a photo. Decades of sketches, photos, patterns, outfits being digitized, tagged and poured into a model that can recombine them in her style. That's not just a nostalgia project. That's an attempt to institutionalize the founder's taste into a system that can survive her. From a compounding standpoint, that's powerful. Most fashion brands decay when the original eye disappears. If an archive-trained AI can serve as a starting point for future designers, you have a better chance of continuity. You're trying to evolve the system beyond its creator, instead of letting it drift. Now contrast that with Chanel. In June, LVMH's chief information officer said their luxury brands were using AI for mood boards, upstream, exploratory work. But Bruno Pavlovsky, president of Chanel Fashion, draws a hard line in this article. Chanel uses AI for some operations, but not for fashion design or creation. His logic is simple. The touch point and specificity of Chanel is to use incredible human designers who bring their own point of view. That's the moat. Taste, not tooling. Two models emerge. One, AI inside the design pipeline, making prints and products faster, as at Alice plus Olivia, Kate Spade Selke's early experiments. Two, AI outside the sanctum of design, supporting operations, insights, maybe marketing, but design remains human because the brand wants to sell the mystique of the human creator. Both are business strategies. Both are capital allocation choices. In one, you spend human and machine capital to increase throughput, lower cost, and respond faster to trend. In the other, you spend extra on human designers as your differentiator, and you risk being slower and more expensive, but maybe more defensible. Now, let's walk through the other players the article puts on stage. Revolve, the online fashion platform, is in full experimentation mode. Co-chief executive Michael Mente says he gets AI updates weekly, and it changes weekly. They're testing tools like Google's Nano Banana. They have a few employees whose job is to test the onslaught of new AI tools and figure out which are actually useful long-term. Co-CEO Mike Caranicolas sums it up. Part of the journey is sorting through the hype. That's exactly what a smart allocator does at this stage of a technology curve. You don't bet the company on one tool. You treat this like a portfolio of options. Small experiments, small checks. Kill what doesn't work. Scale what does. Kate Spade, owned by Tapestry, is a little further down the road. Last year, they started using AI in their handbag design process. According to Lisette Seaschultz, Senior Director of Technical Design, in some cases it saved the team about 2 weeks of sampling. 2 weeks is not an abstraction. In retail, shaving 2 weeks off sampling can be the difference between hitting a season cleanly and missing it, between carrying excess inventory and precise buys. The article gives a concrete example. The Loop small flap shoulder bag, coming this summer, was made with AI assistance. The team input sketch ideas and then used Raspberry AI to help create a soft, slouchy purse. They went back and forth with the tool until they landed on the right design. On screen right now, you'd see a product shot of a small shoulder bag, curved and relaxed, with the caption noting that it was made with the help of AI. JJ Camara, Senior Director of Digital Product Creation at Tapestry, puts the boundary clearly. AI only takes you so far. It's never perfect. The expertise of the design team is still essential. AI is a collaborator, not a replacement. Then you have Selkie and its founder, Kimberly Gordon, as a cautionary tale. She used Midjourney to generate prints for a Valentine's Day collection in 2024. One of those prints was a cat on a sweater, the Cottage Kitty Winter Sweater, which launched early 2024 for $139. On screen, you're seeing that sweater, soft knit, cottagecore vibe, with a cute cat graphic on the front. Next to it, you see a mini headline. Quick prints/AI, generated prints are already hitting the shelves. The price, $139, is emphasized. Gordon says she received death threats for selling that cat on a sweater. Her own customers were angry. She sympathizes, saying it feels yucky to lose the human. That's reputational risk. That's brand equity getting hit because the customer base believed they were buying human art, and then they discovered it was partially machine-generated. She still uses AI now, but only for brainstorming. And she's very clear about the limits. She says AI is not all it's hyped to be. It keeps feeding her the same boring ruffles. Her goal as a designer is to make your heart race. AI doesn't do that. This is a critical point for investors. If the tools push everyone toward the same aesthetic, because they're trained on similar data and optimized for safe options, you get creative regression to the mean. Fashion brands that over-rely on AI risk losing the edge that makes them special. They get cost savings at the expense of differentiation. That's a terrible trade if your moat is brand. Ronnie Kobo, another women's wear designer, sees a different way to use the tools. She is worried that AI could generate designs that are copies of competitors. IP risk at algorithmic scale. So she doesn't let AI roam free. Instead, she uses it to iterate on existing sweaters in her own collection. She calls sweaters a category I built myself and want to repeat, season after season. That's an interesting capital allocation choice. Use AI to deepen a proven category rather than to invent new ones. It's a way of reinforcing a profitable niche instead of expanding into risky new areas. Finally, we circle back to Alice plus Olivia and the concrete evidence that AI prints are not theoretical. They're already on shelves. On the screen now, imagine a split layout. On one side, the Selkie Cottage Kitty Winter Sweater, $139, launched early 2024. On the other, Alice plus Olivia's Tarot print blouse, hitting shelves in January for $395. Underneath, a small label, Quick Prints/AI, generated prints are already hitting the shelves. What's being measured there is not a number, it's a proof of concept. The creator of that layout is saying, these are not lab experiments. These are commercial products, carrying real prices in front of real customers. Companies are already monetizing AI-assisted design. So what's the reality check? First, AI is absolutely speeding up parts of the design pipeline and shaving off cost. Bendit says it saves days, sometimes weeks. Kate Spade says it saved about 2 weeks of sampling. That's real. Second, AI is already changing the job mix. Entry-level tech pack and production roles are exposed. Mid-level design roles that can harness AI become more central. Challenger's 55,000 lost jobs figure tells you this isn't a vague future risk. It's happening now. Third, the brand and creative risks are non-trivial. Selkie's death threats, Gordon's yucky feeling. Her experience that AI gives her boring ruffles, not heart-racing designs. Chanel's deliberate decision to keep AI away from design and creation, to protect the aura of human authorship. Most people will look at this article and say, cool, AI prints. As long-term investors, we should see a set of very specific questions. Does AI become table stakes in fashion design? Everyone uses it, nobody differentiates on it. Or does it create new winners who learn to combine speed and authenticity better than the rest? Do the brands that lean hardest into AI gain operational leverage, but slowly hollow out their creative core? Or do they free up their best designers to focus only on the ideas that make your heart race while the machine handles the grunt work? Do founders like Bendet and Kamali succeed in using AI to preserve and amplify their taste over time? Or does the technology accelerate copycatting and compression of style differences across the industry? 3 lessons stand out from this Wall Street Journal piece. First, incentives shape outcomes. If your incentive is to hit quarterly delivery dates and cut sampling costs, you will push AI deeper into design. If your incentive is to protect a century-old luxury aura, you will wall it off from creation and use it only in the back office. The same tool plays out very differently depending on what the board, the founder, and the customers value. Second, scale can become a disadvantage if it's tied to sameness. Large platforms like Revolve are blasted with new tools every week. If they just plug AI into everything without a clear aesthetic POV, they risk flooding the market with algorithmically optimized, utterly forgettable product. It's not enough to be fast, you have to be distinct. At scale, sameness kills pricing power. Third, success plants the seeds of failure when it disconnects from the human the brand is selling. The reason customers pay $395 for an Alice plus Olivia blouse or $139 for a Selkie sweater is not just fabric and print, it's the story. This came from a specific mind, a specific world. The moment they feel that story has been swapped for a prompt and a model, the price premium is at risk. AI that quietly enhances that story will compound. AI that replaces it will backfire. In the end, the core question this article raises is simple. In a world of AI-accelerated design, will the brands that compound be the ones that automate creativity, or the ones that use automation to protect and extend the human spark at their core? And the sentence to remember is this: in a fashion industry racing to plug into AI, the only brands that will still matter in 20 years are the ones that use the machine to serve the muse, not replace her. This is Avi. Like and subscribe. On to the next.